Awesome. So let me scroll down and let you
Yeah.
guys.
Yes. Let's go to why the whole Dodd-Frank Protection Act got started. You know, the too big to fail situation in 2008, the financial crisis. They were giving loans to anybody that had a heartbeat, right? Anybody that had a pulse, they were giving loans to. So that, you know, it crashed our you know, our financial system, and so they don't want that to happen again. And so how do they fix that? Is just to regulate any lender. It doesn't matter if you're a bank or a broker or you know, a seller finance person that's loaning money. I do, and just to add to that, I don't only just work with seller finance investors. I also work with a lot of people that are offering private financing. So a lot of investors are creating kind of like a loan fund or a hedge fund, and they are just loaning money to anybody that wants to go buy a house, you know, and so you're acting as a bank. So if you're doing that, you know, this is where you need to make sure that you're following these rules. But
so
yes,
real quick question, they ask about, does this affect any kind of land notes as well? Does land play a role at all in this?
Okay, so that's a great question. I get that all the time. So vacant land or vacant lots, if that person is going to utilize that vacant lot as their homestead residence within the first 5 years of that note, then yes, you have to follow these rules and regulations. Because, okay, so this is what happens. You sell a lot, you're like, oh, you know, I can sell it however, I don't have to go through an RMLO. And then in 2 years, they build a house or they move a permanent mobile home there. And now it's their homestead, and now and then you have to foreclose. Well, guess what? They're going to say, wait a minute, this is their homestead. Why didn't you originate it correctly? So just to protect you again, you know, number one and number two. So if you do create a qualified mortgage on that vacant lot, a lot of people are selling those notes, right? They're splitting up. They'll go buy 100 acres, split it all up, and then sell those notes and do it all over again.
Yeah. So we're really worried about.
Let me just add on that.
Yeah, go ahead.
So I'm going to add that when you're selling notes, you know, when you go to a note buyer, what do you say? Oh, I have this piece of land over here, and what do you give them? What do you give them? Just a three paper document with a promissory note. So with our package, you can actually give them a stack of 100-page package that makes you look organized, legit, and makes you look like somebody I want to do business with, right?
Yeah.
Your note buyer is going to be impressed. And your note buyer is going to say, bring me more. I want to do business with you. But if you bring them a 3-page promissory note, they're like, what is this?
Yeah. 2 weeks ago, I got one that I had 2 notes. They were 1 page each. And I'm like, oh my gosh, come on. That's not going to fly.
And there's a lot of things that go into these notes. We were talking about in a previous webinar, the fact that you must include certain things in this note, right? When the date of the first payment, the interest rate, your monthly payment should be separated with your P&I, with your monthly principal and interest payment, separated from the escrow amount. That has to be separated. And you have to make sure inside the escrow that you're saying to the borrower, it was subject to change. We've seen too many papers recently where they merged the PITI, principal, interest, tax, and insurance, into one payment, and they don't put anything about the fact that the escrow will change or adjust over years if interest goes up. So then it gets stuck in a balloon. And we could talk more about that if you want to reach out. What that means, it's just dangerous to do. So you need to write that note, clear cut, the start date, what's the term, what's the P&I, what's the escrow, what's the full monthly payment, what's the expectations, and everything, interest rate, everything in there to make sure the borrower is well aware of what's going on.
Even an amortization schedule is almost mandatory too, so that the buyer really understands, you know, the amortization of the loan.
Yeah, you gotta have your truth in lending stuff in there. Like it's a 1 page, 2 page, 3 page. That is, I guarantee you don't have everything in there that you need to have.
Yeah, so it's not just the Dodd-Frank rules, it's also the RESPA rules, the truth in lending rules. There's a lot of laws that you have to abide by. And so, you know, definitely seek professional help, third party, to do that kind of stuff, to lead you in the right direction, make sure that you're writing good paper.
So Cindy's got a good question. Let's say you say, well, I use my attorney to draw everything up. Is that good enough? Does that qualify? If I have an attorney draw everything up, is that good?
Well, okay, so your attorney's not going to have a loan system that's going to give a loan estimate with the APR. So one of the other rules is that you have to disclose the APOR to your buyer.
Mhm.
The annual percentage, rate on the. So your attorney doesn't have a loan system that's going to spit that out for you. They're not gonna have the qualified mortgage report that says, hey, you actually created a qualified mortgage, and here's the results and the proof. And your attorney's not going to have. I'm thinking all he can do. He can legally originate that loan for you. Yes, they are legally able to do that. But all you're still just going to get your promissory note and deed of trust. You're not going to get all the other required loan disclosures that are required by law on any real estate transaction, right? It's not just seller finance, but when you're doing a real estate transaction, you also have to include all the other RESPA disclosures.
Yeah.
So I'm not sure if your attorney has those that, I've seen a lot of attorney packages over the years, and sometimes I'm just like, I can't believe that this closing package is, 7 pages.
Yeah.
So just beware, be careful. If you are going to have your attorney originate that loan for you on your behalf, make sure that they're checking all the boxes and that your buyer's getting all the disclosures that they're supposed to be getting.
Yeah.
But just to make sure we're accurate, just ATOR stands for, someone asked that question. What does ATOR stand for?
The APOR. So yeah, that's the annual percentage offer rate. So we'll get that. Well, there's another slide on that here in a minute. So we, let's see if we want to go down to that. Yeah, I think we probably already talked about all this.
We went over this a little bit before. Okay. Any highlights you want to kind of cover on this before we go the next slide?
Yes. So really just the difference between an RMLO and the underwriter, right? Mm-hmm. So the RMLO is actually originating that loan for you on your behalf as a lender. The underwriter is just making sure that the buyer has the ability to repay. So I know that there's this big company out there that says call the underwriter. Mm-hmm. But all they're doing is just doing what you could probably do yourself and say, okay, these are your debt. This is the buyer's debts and this is their income, and do the math, right? That's all pretty much what they're doing. They're going to just look at all the proof of income that you're providing to them, because they don't go out and get that directly from the buyer. And they're just doing pretty much the math for you and calculating it for you. I don't think that an underwriter call the underwriter, whatever they provide is not sufficient for number one, the licensing requirement, and number two, something that you could probably just do on your own if you're just really just trying to figure out whether they have the ability to repay or not. Okay. So it's a big difference.
Yeah. So just
you still need an RMLO to originate.
Coming through. Mm-hmm. So I sent a message to Nathan. So just to kind of feed anything, we're trying to feed everything in, and we're doing our best to answer all the questions. But just understand that if you have additional questions, feel free to shoot us an email or click the form. It's in the box, and we'll get through as much we can today. I know that one of the things we're focusing on here is the borrower, right? This is all about the borrower. Make sure they have the ability to repay, make sure the rate's not too high, make sure it's a legitimate loan, and we're passing all the legal Dodd-Frank rulings and stuff like that. So, and we have some really great people in the chat going back and forth. I see Mark, I see Sohal, I see Nick on, of course. And we're gonna get as much questions as we possibly can in the process of doing all this stuff. So cool.
Okay. Yeah, we can go to the next slide and try to.
Absolutely. So I'm juggling a little few things. So. All right. So ATR, before we get there, what does ATR stand for again, for those who may not know?
Ability to repay.
Ability to repay. Again, folks and the borrower. Cool. Thank you much.
Okay. So Dodd-Frank does not set any kind of specific rule on the DTI, because I know that's a huge question for everybody. Well, what DTI are they supposed to be under?
Net to income, by the way, for those who don't know.
Oh, sorry.
It's okay.
No, that's good.
And just the loan officer side.
And just the FYI,
the
APOR, correct. So if you made a mistake and you did this incorrectly, we're going to get to that. So bear with us. We may be a little longer than an hour. We expected an hour and a half, but we're going to get to as much as we can. So go ahead. Sorry, go ahead.
It's okay. So just to touch on the DTI, you verify, consider the DTI that they're going to provide. We do pull credit and we don't look at credit scores. All we're looking at is the liabilities. And so we take their proof of income, we take their liabilities, and then that's how we come up with the DTI. So that's the debt to income ratios. So when we do that, you get a percentage. And so we just like to stay under 48% DTI. Again, there's no set number. It's going to be each investor's, whatever they choose to do and how to set their underwriting guidelines for themselves and for their buyers. But what I like to do is I just kind of go based off of what the guidelines are in for FHA or for Freddie Mac. I just try to follow those. I think FHA went all the way up to 50% this past year. So I'm not too familiar with the conventional financing, but I do like to stay up on if there's any changes on DTI thresholds, so that we can kind of mirror those thresholds for you.
Okay.
So I'm gonna scroll down here.
And again, and so for the underwriting too, it's just really just makes sense underwriting. You just need to make sure that you're looking at everything. And we have a lot of people, a lot of our end buyers are cash buyers or self-employed buyers. So a lot of the questions that I get, what if they get paid cash? So you really just have to do an analysis. We'll take 6 months of their bank statements and we'll average out 6 months of whatever they're depositing every month, and come up with that monthly income for them.
Yeah.
So.
Okay.
And for those, idea about the DTI, it's all about the borrower. So the lower, the better you are, because then you just have a better quality note in the eyes of the law. So yeah, so Al, absolutely. Kevin Cordell also asked a question, is that made a comment, which is really key, that MLO is the only person allowed to discuss the consumer, right? They're negotiating the loan per se, right? They're talking to the consumer. Because if you do any kind of conversation with that borrower, you're not licensed to have that conversation. Is that correct?
That is correct, yes. So that's why you hire the RMLO, is to do those negotiations with you or disclose those loan terms to the buyer and kind of speak on your behalf, right? Of what your interest rate requirements are, down payment requirements, all of that.
Yeah, awesome.
Great.
So, qualified mortgage, we have 5 points we're focused on.